September 2008, Lehman Brothers collapses. The S&P 500 plunges 37% in 6 months. Retirement accounts across America are slaughtered. Panic consumes Wall Street. At Bridgewater Associates in Connecticut, Ray Dalio watches his all-weather fund lose just 3.93%. Not 37%, not 20%, not even 10%. While the market burns, his strategy barely flinches. Fast forward to March 2020. COVID crashes markets 34% in 33 days. The all-weather portfolio? Down just 6%. Then 2022, both stocks and bonds collapse together. The all-weather? Down around 12% while the S&P falls 18%. 3 different crises, 3 different causes. The same portfolio survived all of them, not by predicting the future, but by being prepared for any future. This is Ray Dalio's all-weather portfolio, and today I'm showing you exactly how it works, why it works, and how you can build it yourself with simple ETFs. Disclaimer: this video is for educational purposes only. Always consult with qualified professionals before making investment decisions. Ray Dalio founded Bridgewater Associates in 1975 from his 2-bedroom apartment. Today, it manages over $120 billion, the largest hedge fund in the world. But in 1982, Dalio made a catastrophic prediction. He was convinced the U.S. economy was headed for a depression. He bet everything on it. He was spectacularly wrong. The opposite happened. One of the greatest bull markets in history began. Bridgewater nearly went bankrupt. Dalio had to borrow $4,000 from his father just to survive. He fired everyone except one employee. The experience was humiliating, but from that failure, Dalio learned the most valuable lesson of his career. Nobody can consistently predict which way markets will move. Not him, not anyone. So he stopped trying. Instead, he asked a different question. What if I assume I don't know what the future holds? How would I invest then? The answer became the all-weather portfolio, designed in the 1990s for pension funds and institutional investors who needed returns but couldn't afford catastrophic losses. Dalio organized the economy into 4 possible states, 4 seasons, and built a portfolio that could thrive in each one. Season 1, rising growth. Stocks and corporate bonds thrive. Season 2, falling growth, recession. Government bonds surge. Season 3, rising inflation. Commodities and gold preserve value. Season 4, deflation. Long-term bonds soar. Most portfolios are overweight in 1 or 2 seasons. The all-weather balances risk across all 4. That way, roughly 25% of your portfolio thrives no matter what happens, while the rest provides stability. From 1996 to 2020, it averaged 9.7% annual returns with dramatically lower volatility than stocks alone. When Tony Robbins interviewed Dalio in 2014, Dalio called this allocation suitable and easy to manage for the average investor. So what does the actual all-weather portfolio look like? 30% U.S. stocks, 40% long-term bonds, 20 to 30-year treasuries, 15% intermediate-term bonds, 7 to 10-year treasuries, 7.5% commodities, 7.5% gold. Wait, only 30% stocks? Don't you need 80 to 100% stocks to build wealth? Here's the key insight. Dalio uses risk parity, balancing the risk contribution, not just the dollar contribution. Stocks are roughly 3 times more volatile than bonds, so 30% stocks contributes about the same amount of risk as 55% bonds. The result: smoother returns, smaller drawdowns, faster recoveries. Why 40% in long-term bonds? Long-term bonds, 20 to 30-year maturities, are incredibly sensitive to interest rate changes. When recession or deflation hits and rates fall, these bonds surge in value. They're your insurance policy against economic contraction. Why commodities and gold? Commodities rise when inflation accelerates: oil, copper, agriculture. Gold performs during both inflation and financial crises. Together, they protect your purchasing power when prices rise.
The allocation looks defensive, and it is, but that's intentional. The all-weather portfolio is designed to survive, not to maximize gains. You're explicitly trading some upside potential for dramatically reduced downside risk. And the historical data proves it works. From 1995 to 2025, 7.36% compound annual return. Maximum drawdown minus 20.58%. Recovery time, 42 months average. Compare that to the S&P's 50+% drawdown in 2008 that took 5+ years to recover. The consistency is remarkable. 37 positive years, 5 negative years, 88% win rate. Average recovery time, 16 months versus S&P's 38 months. Theory is one thing, real-world performance is what matters. The 2008 financial crisis. Bridgewater's all-weather fund, minus 3.93%. The S&P 500, minus 37%. While stocks and corporate bonds collapsed, long-term government bonds surged. The portfolio saved it. The 2020 COVID crash. All-weather portfolio, minus 6%. S&P 500, minus 34%. Bonds and gold offset stock losses. The portfolio recovered within months, while many portfolios took over a year. The 2022 bear market. This was the real test. Inflation surged. The Fed hiked rates aggressively. Both stocks and bonds fell together, something that's supposed to be impossible. All-weather portfolio, minus 12%. S&P 500, minus 18%. Not perfect, but still less painful, and it recovered faster. The pattern is clear. The all-weather portfolio doesn't avoid losses entirely, no strategy can, but it consistently loses less during crashes and recovers faster. That's the entire value proposition. Smaller drawdowns, faster recoveries, smoother wealth accumulation over time. So, how do you actually implement this? It's surprisingly simple. Option 1, the one-click solution. There's an ETF called All-Wear that mirrors Dalio's strategy. You buy it, you're done. The downside, it has a 0.85% expense ratio, relatively expensive for a passive strategy. Option 2, DIY with low-cost ETFs, recommended. Build it yourself using these simple ETFs. 30% VTI or SPY, US total stock market, 40% TLT, 20+ year treasury bonds, 15% IEF, 7 to 10 year treasuries, 7.5% DBC or GSG, commodities, 7.5% GLD or IAU, gold. You can build this in any brokerage account, Fidelity, Vanguard, Schwab, M1 Finance. Most platforms now offer commission-free trading. Option 3, the Vanguard version. If you prefer Vanguard funds, 30% VTI, 40% VGLT, long-term treasury, 15% VGIT, intermediate treasury, 7.5% DBC, commodities, 7.5% GLD, gold. Rebalancing is critical. This is not set it and forget it forever. You need to rebalance quarterly or annually. Why? Because markets move. If stocks rally hard, your 30% allocation might become 40%. That shifts your risk profile away from the all-weather design. Rebalancing forces you to sell winners and buy losers, buying low, selling high, mechanically. It feels uncomfortable, but it's mathematically optimal. Who should use this strategy? The all-weather portfolio is ideal for conservative investors prioritizing capital preservation, retirees who can't afford 50% drawdowns, people nearing retirement within 5 to 10 years, investors with low risk tolerance, anyone wanting smoother, more predictable returns. It's not ideal for young, aggressive investors with 30+ year horizons, people comfortable with high volatility, those seeking maximum growth at any cost. If you're 25 with decades to invest, 100% stocks historically delivers higher returns despite volatility. But if you're 55 and retiring in 10 years, the all-weather strategy might be perfect. No strategy is perfect. Let's be honest about the all-weather portfolio's weaknesses. Limitation number 1, lower returns in bull markets. During 2010 to 2021's incredible bull run, the all-weather portfolio significantly underperformed 100% stock portfolios. You're giving up gains for safety. If you can tolerate volatility, stocks historically outperform over very long periods. Limitation number 2, vulnerable to rising rates. When interest rates rise sharply, like 2022 to 2023, bonds lose value. The all-weather portfolio's heavy bond allocation, 55%, makes it vulnerable. This is exactly what happened in 2022 when both stocks and bonds fell together. Limitation number 3, commodities are volatile. Commodities can go through long periods of terrible performance. They're difficult to hold psychologically. Some investors replace the commodity allocation with REITs for real estate for more stable returns. Limitation number 4, not optimized for maximum returns. The all-weather portfolio is optimized for risk-adjusted return
and consistency, not maximum returns. It's designed to survive, not to win. If your goal is aggressive wealth accumulation, this will feel too conservative. The bottom line? The all-weather portfolio trades maximum upside for reduced downside. That trade-off is explicit and intentional. You need to decide if smoother returns and smaller drawdowns are worth potentially lower gains in bull markets. In 1982, Ray Dalio nearly lost everything by trying to predict the future. That catastrophic failure taught him the most valuable lesson: stop predicting, start preparing. The all-weather portfolio doesn't try to time the market or guess which economic season is coming. It simply assumes you don't know and positions you to survive and thrive regardless. The results speak for themselves. 9.7% annual returns from 1996 to 2020. Only 6% drawdown during COVID. Just 3.93% loss during 2008. 88% positive years. 16-month average recovery versus 38 months for the S&P. It's not the sexiest strategy. It won't make you rich overnight, but it will help you stay rich, and that's often more important. Whether you use it for 25% of your portfolio, 50%, or 100%, the all-weather framework teaches a timeless lesson. Preparation beats prediction. Diversification across economic environments beats concentration and hope. If you found this breakdown valuable, here's what I need. First, subscribe. We break down legendary investment strategies like this every week, billionaire-tested frameworks you can actually implement. Second, comment below. Would you use the all-weather portfolio? I read every comment. Third, share this with someone nervous about market volatility or approaching retirement. This strategy could change how they sleep at night. Remember, this is educational content, not financial advice. Always do your own research. Because understanding how Ray Dalio built a portfolio that survived every crisis isn't just interesting, it's a framework you can use to protect your own wealth. I'll see